Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with Dick Pfister. How you doing today, Dick?
Great. Thanks for having me, Kirk.
Good. Well, glad to have you in the show here. Tell us a little bit about your background. Like I wanted to bring you on because you do some interesting stuff, but tell us a little bit about your background.
Yeah, my background is a little bit different than a typical wealth advisor in that I started as a floor trader on the floor of the Chicago Mercantile Exchange in the Japanese yen pit in the early to mid 90s. So my first foray into the financial services and then eventually the financial advisory world came from the world of derivatives and alternative strategies. And I used to work for a firm which many of your listeners might know named Dean Witter. So Dean Witter was at the time the largest futures clearing firm in the world, and got exposed very early days to what hedging truly meant, what speculation truly meant, and then good risk management across the variety of different futures and options strategies that various hedge funds and institutional money managers employed. And that got me hooked on the world of how do you allocate to all sorts of asset classes, including stocks, bonds, and alternatives. So today I've been in the industry nearly 30 years, and Alvacor emphasizes the use of alternative strategies in our wealth advisory practice. So that's kind of where what's led me to 2023, and we've got a lot more opportunity in front of us, I believe.
Nice. So what to you is attractive about alternatives? What makes that different than the traditional realm?
Yeah, it's a good question. I think the key to that answer is to delineate the different types of alternatives. And we like to categorize alternatives into two major buckets. One we call alternative asset classes. And that includes things like private equity or private credit, private real estate, venture capital. Those are typically a little bit longer term lockup alternative strategies. They're trying to capture an illiquidity premium of their various asset classes. The other major category we call alternative strategies, and those are more hedging-like strategies where you can go long or short stocks. You could trade currencies or commodities, things like global macro, trend following, multi-strategy. And those are meant to be strategies that can provide non-correlated returns when stocks or bonds are up or down. So that's how we define those. And in today's environment, with much increased interest rates and higher volatility and all the geopolitical concerns that are going on, we think you're going to want more of those strategies in a well-diversified portfolio than you would have had in the previous 10 years.
Okay. Yeah, I mean, that makes a lot of sense. I mean, certainly in this environment with we call it the new paradigm, which is everything has changed. And I think a lot of people haven't really comprehended what that means yet. So in your viewpoint, I mean, if you use the context of the old paradigm, which was 0% interest rates, the TINA approach, just all of it, everyone just was really successful just putting it all in equities. So comparing that paradigm to what's happening now, which is a completely different paradigm, and I don't think the markets have adjusted to it yet. How do you think that those are going to perform given the wide range of parameters that have changed?
Well, that's also an excellent question. I think you have to remember that most investors or allocators have grown up in that TINA world where post 08, where the Fed would lower rates or do quantitative easing 1, 2, 3, or 4. And anytime you saw some market volatility, the Fed was there to bail you out. And primarily the reason they could do that was that we didn't have high inflation when that was happening. Today, the Fed really can't force their hand and actually print money or issue new bonds because the inflation is so high. So they have to raise rates. And it reminds us of the 80s or the 90s because the interest rates environment was very similar to what it is today. The average 10-year yield is somewhere between 4.5% and 5%. So we're kind of going back to those historical averages. But if you look back into the 80s and 90s, you'll see that market volatility was generally higher than it had been, post credit crisis. And so what that allowed more actively managed strategies to do was to perform and find arbitrages, find idiosyncratic opportunities. And that then allows these alternative strategies to make money. So the higher the volatility, the more dispersion between stock prices, that allows a variety of alternative strategies to perform and produce alpha. And I think that the last 10 years is going to look nothing like the next 10 years, right? So that's going to be a dramatic shift for many investors.
Yeah, you'd mentioned the 80s and 90s for sure, and that was a time where interest rates are dropping and bonds pretty much made money every year. But what about the 70s? I mean, to me, it feels a lot like this is more like the 70s than the 80s and 90s. I mean, I don't know if you've studied the 70s. I know it's kind of a little far back for most of us that have been around. But what are your thoughts on that?
I've got a funny story about the 70s. So I was born in 1971. So I guess that dates me a little bit here. But my father was a dentist in northern Wisconsin. And in dentists, if you remember, when they would put in fillings, they would put in gold or silver fillings. That was before enamel was in teeth, in any major way. So my father actually got exposure into gold Krugerrands in the early 70s, late 60s. And he told me the story as I grew up, a little bit as I got it to 8 or 9 or 10 years old, and why he owned gold Krugerrands. And the reason he did was inflation was so high in the 70s, and mortgages and interest rates were so high, and he had access to gold because he was a dentist and knew other dentists who bought Krugerrands. So I kind of was growing up in that world of high inflation, high mortgage rates, and it does, we're not necessarily at those levels on a real basis perspective, but inflation adjusted, we're kind of there. So it definitely reminds us of those times. History doesn't necessarily exactly repeat itself. It rhymes, as we've all heard. And so I think you could learn from the 70s. I think you could understand a little bit more about the markets. Things are different technologically than it was in the 70s. So I think we have different opportunities, but there are some similarities for sure. I agree.
Yeah, I know you raise a good point, because back in the 70s and 80s and certainly the early 90s, technology was different. Like our industry was not technologically advanced. I remember when I started in 99, we had the blue screen of death. We had everything was on a blue screen. It had this square cursor that kept blinking at you. And it was like, I was like, wow, that was like my first year. Shortly thereafter, they went to normal computers, but still, like that was kind of the tail end. So it kind of brings up this point that you're making is, technology is drastically different. And many of the strategies that you're talking about with alternatives, I don't want to say didn't exist then, but they certainly weren't popular. Like hedge funds didn't get quote unquote popular until late 90s. And I'm sure they were around as private equity was, but it wasn't really popular. So as the market structure has changed, how do you think that these new strategies are going to do with this new market structure, considering the market structure kind of flattens the field for most people?
Yeah, it's a good question. I think that what's happened in a very big way for individual investors or retail investors is the access to these managers has dramatically changed. So there are now vehicles that weren't even available 10 years ago. Furthermore, 20 years ago, definitely not available. So you can get some alternative strategies in a mutual fund or an interval fund, or you can access limited partnership or private placements on platforms at a much lower minimum. And you can actually subscribe with electronic subdocs, all these things that didn't exist 20 years ago, especially not 50 years ago, right? So there's definitely a technological advancement that has happened that allows investors to get invested to just start with. I think that's generally a good thing, right? That's generally allowing kind of this democratization of access is generally a good thing for investors. The thing that you're mentioning is like, hey, now that there's access, doesn't that involve crowding out of certain strategies? And I do think that's sometimes the case, right? Especially when there's not a lot of volatility. So if you look back from the 2008 crisis to up until kind of COVID, there was this lack of volatility and this compression of volatility that was kind of put on the markets by the Federal Reserve, lowering rates and doing various quantitative easing strategies. And that was also harmful to strategies that were looking for opportunities on either the long or the short side of the market. But now, because the Fed's hand is kind of forced a little bit to raise rates, that has provided back that dispersion again. And I think that we haven't seen since the early 90s, really. And so that's, that might be shorter lived because of technology. Maybe that opportunity doesn't last for another decade, but maybe it'll last for maybe 3 to 5 years, because people can access and arbitrage those opportunities away. But I think it's here for at least the foreseeable future.
Yeah, it brings up some interesting thoughts here because you're talking about access. And I remember the late 90s, it was hedge funds were cool, right? It was like, oh, I got a hedge fund, and you can brag to your friends, I'm in a hedge fund. And then it was managed futures. Managed futures were cool. Hey, I got access to, you don't have this, and it was this bragging of access. And then now it's private equity. And it kind of brings up the point of every time the whole world gets access, all of a sudden the returns dry up, and it's almost as if, well, we already got all the profits out. Let's dump it on the public. So private equity, that's been the case for the last few years. So what are your thoughts on private equity? To me, it seems like it's at the tail end of its cycle here.
Yeah, I think what's interesting about private equity and a lot of different private markets, we could talk about private credit and private real estate too. Those, they've created vehicles where an individual can get access to kind of the best of breed in private equity. The timing of private equity, when you allocate to private equity, they'll call it a vintage, or X vintage this year, that year, 3 years from now. That still applies, right? It still applies to when you're going to be buying these private companies. These are private companies. They're illiquid, but their corollary is the public companies that are liquid and you can get in and out of. So if you're buying, let's say, the S&P 500 and earnings and PE ratios are extremely high, you might have a poor vintage, quote unquote, for public equity. If you do that same thing and you buy private equity, let's imagine you bought it 2 years, 3 years ago, you might have bought an unfortunate vintage, right? Because they might have to mark that down over the course of the next 2, 3, 4 years. If you believe the market might have a reset or a pullback over the next 2 to 3, 4 years, you might want to look at a new vintage of private equity. And that won't necessarily help the people who've allocated to private equity already, but it's usually those times, and you mentioned this too, Kirk, it's like, hey, there's these inflection points. Everybody jumps in. A lot of people have jumped into private equity over the last 3 to 5 years. And now there's people who might want to get out of these interval funds, these structures that might be gated. And you really should be looking the opposite way and kind of, be fearful when everyone's greedy and be greedy when everyone's fearful. That's the same thing that happened with things like managed futures or REITs and things over the course of years, right? Everybody was jumping into managed futures in 2009, right after the crisis, and that turned out to be one of the worst periods of time to allocate to systematic trend following managed futures. So everybody started bailing out of managed futures about 3 years ago, and it's probably the best time to be getting back into managed futures.
So it kind of brings up the question, though, right? Because all these different strategies or asset class, depending on how you want to characterize them, are go in and out of favor. So how do you manage that, right? Because we can't tell the future, and like you said, some things go in and out of favor. And looking at the markets now, it seems kind of obvious to me what's probably going to be out of favor. Hard to imagine what's going to be in favor. But how do you manage that? How do you manage that in general? Let's start there.
Yeah. I think this might sound like a boring answer, but when you get in underneath it a little bit, it's a little bit more exciting. I think diversification will help a lot of this. And if you take a page from the traditional investing playbook, diversification across sector, across US versus international, across various durations and treasuries, that's kind of what you would hope from a call it a 60-40 diversified balanced portfolio. You have to take that same mentality when you go to the world of alternatives. You have to not pick one manager, not one strategy, not one style, diversify it across multiple managers, multiple strategies. So, when you go into alts and you say, well, I'm only going to buy private equity and private credit, that's my alts exposure. That's not diversified alts exposure, right? If you went in and said, all I'm going to do is buy managed futures, I'd say that's not diversified alts exposure, right? You need to have long, short, global macro, managed futures, merger arb. You need to have private equity, private credit, private real estate, venture capital. You need to have a diversified portfolio. And when you look at the most successful investors in alts over time, those are typically the endowments, the pensions. They have the ability to be diversified, and they know how to diversify so that they're not overlapping on the same types of risk exposures. right? And a great example of that would be, let's imagine you're a value investor on the long only equity side, and you think value is where it's at. And obviously last year, that was a great place to be in value. But you say, also, I want to have some long short equity exposure because I think alternatives are here to stay, and I want to buy a long short manager. If you go into the long short world and you say, well, I'm going to buy this manager because they're long value and short growth, well, you're already long value and essentially short growth by not being in it on the long side. So you've just doubled up on your exposure to value. And that, to us, is the kind of nuance you need to understand before you make alternative allocations. And that's what we do. That's where we help people understand intelligently how to allocate.
Yeah, I think that's a great point. You know, and it also kind of brings up the other thing. You mentioned 60-40 portfolios, which obviously did not do very well last year, and I would imagine in this new paradigm may continue not to do well. You know, and I think the challenge that I bring up, well, let me just ask the questions first. But when you come to the allocations when the paradigm has changed, how are you going about that? What's your process to determine like proper diversification in a world where it's questionable as whether there's diversification ability nowadays?
Sure. I think, you know, this might sound boring again, but you have to go down to the individual investor and you have to understand their needs, goals, wants, their liquidity requirements, the volatility that they can handle in a portfolio. So you have to have those answers. And I guess that's just kind of like the table stakes to get in the game. You should know those answers before you make an allocation, either for yourself or on behalf of somebody else. So you need to know those answers. But imagine if you use a kind of a standard portfolio. Let's imagine you could hold your portfolio for 10 years and you didn't need access to it from a day-to-day living expense perspective. Well, then you'd say, okay, what kind of world are we in? And where do we think we're going to be for the next 10 years? And again, you go back to, okay, well, I'm not bearish generally on the world economy, right? If you walk into this thinking, I'm just bearish on everything, I don't care if it's US, Europe, Asia, India, I'm just bearish. Well, that's going to probably lean you too heavily into this bear mode where you're going to probably take off all your exposure to equities, right? So you have to approach this thing in that which is a kind of a big top-down review, is say, okay, I'm gonna be generally bullish on innovation and human capital, and the world is going to be a better place 10 years from now. And that's kind of this big picture part, right? If you have that view, you definitely need to have some long only equities, and maybe they're diversified globally, right? The other part is, now just don't be naive and be Pollyannish about that everything's going to be great. Well, because we know we've got geopolitical concerns, there's wars going on, we've got an election coming up. So there's probably going to be more volatility than we're used to. So what do you do in that scenario? What strategies could do well in that strategy? Well, that means things like managers who can go long and short, things like people that can hedge you. If you can look for merger arbitrage opportunities or convertible bond arbitrage, I would say that that's probably more likely than it was over the last 10 years that we're going to have higher volatility. So you need to have those types of strategies to complement your long only exposure that you have. The nice thing now is that interest rates are higher. And if you do have a client that needs income, you can put together a laddered bond portfolio of various types and get some income again. And that's kind of a nice world to live in once again.
Yeah, no, it's yeah, because I mean, basically, here's the concern, right? So I remember doing a correlation study back in 2008 because we were just, the market was ugly and we were just sitting on our hands, which is the best thing to do at that point. And so we were doing some research on it, and we did a correlation study. And what I realized was a few things. First off, in the 2000s to today, there's an inverse correlation with stocks and bonds, but that wasn't always the case. And pretty much from the 60s, the 70s, there was, and parts of the 80s, there was a very low, it was a negative, there's a positive correlation, but it flip-flops. There's a positive and negative. It's gone back and forth over the last 100 years. And so, that's interesting in of itself. But the other interesting thing I found is, if you look at alternatives, there were a lot of great non-correlated alternatives, like Timberland REITs were the best in 2001. Sure. And then everyone found out about them and invested in them, and all of a sudden they became correlated. So
Yeah.
it brings up the question of how do you really truly get non-correlation in a portfolio when the institutionalization of the asset is what correlates it?
Yeah. That's interesting way to look at it. I look at it in a similar way, but define it a little bit differently. So if you look at the construct, or call it the wrappers of these various alternatives, let's imagine it's a limited partnership, or it's a BDC, or an interval fund, or a mutual fund. That's just the wrapper to get you access, right? So you kind of have to take that for what it is. When you really want to understand what the manager is doing, let's say it's Timberland, or it's private equity, or it's commodity exposure, there's various risk factors that you're going to get exposure to. And those risk factors might be beta of those various asset classes. So if it was Timberland, or it's farmland, or it's commodities or gold, whatever it is, you're getting beta to that particular market. And in those cases, it's long only beta, right? So if you have a worldwide recession or depression, the long only beta of a lot of these asset classes will go down and correlate more to the stock market. And just similar to 08, or tech wreck of those things, or even 1998. So you have to walk into these things with your eyes wide open. Hey, do I have a risk factor that's really much more of a kind of illiquid beta than truly a diversifier? So that's one thing to be conscious of. I think a lot of times allocators go into these sectors. Let's use private credit as another example. Private credit has definitely been the hot thing lately, right? Private credit is unique. It's interesting. It's kind of where the banks don't go, and they haven't gone since Dodd-Frank, and we like it. It's interesting. But at the end of it, these are loans being made to companies. So don't kid yourself that that's a hedging opportunity. That's a loan being made. And if default rates jump higher, they're going to have a more difficult time. So just because it's wrapped and it's called an alternative doesn't truly mean it's necessarily going to give you alpha or non-correlated returns in an economic crisis. So then you say, well, what does then? Well, what's left? Now that's the hard part. The hard part is, okay, well, who truly is a good global macro discretionary trader? Who truly has a trend following model that can work in these environments? Or who knows how to hedge convertible bond arb when the market, takes a hit? So that's where you have to understand in the nuances of who's good and who's not in those more actively managed strategies.
Yeah, no, I think that's a good way to look at it. So I wanted to get into a few things you mentioned. One of them was private credit. Can you talk a little bit about that? Because I think it makes it sound cool and interesting, but I don't think people really understand it. Most people don't.
Yeah, the world of private credit is definitely interesting. I think a lot of things changed after 08. We had some laws that were passed that didn't necessarily allow the banks to lend to, call it, the small or middle market private companies in a meaningful way, right? So banks were kind of relegated to lending money to the large behemoth kind of companies, the multi-billion-dollar companies that are out there. So that kind of spawned a unique group of alternative managers that are private credit managers. So some of the teams that were actually doing the loan analysis and underwriting loans of the banks left, and they joined some of these other great alternative strategy managers doing the same kind of work they were doing, lending to $200 million to $2 billion type of EBITDA companies. And the banks weren't really competing anymore because they were kind of, regulated out of that industry. So there's been some what happens in that world is, because the banks aren't there, these private credit managers can charge 200, 300, 500 basis points more on their loans. And you as an investor can get access to the higher yield. So it's interesting. It's very unique, and you have to understand who's doing it, what sectors they're lending to. But we like it. It's just that you have to go in fully educated on what you're getting exposure to. And if you're looking for a slightly higher yield than you could get, let's say, in a short duration treasury bond portfolio, you can get that in private credit. It's not going to be as liquid, right? It's going to have more credit risk, but it's interesting.
Yeah. Okay. And then, so where are you seeing opportunities now? I mean, the market is certainly a little topsy-turvy, and as you said, things don't always hold up in a crisis, which everybody's predicting right now, which means we probably won't have it, but it seems like we're overdue. So, what are you seeing that's attractive nowadays? That's,
Mhm.
whether it's terms of valuation or opportunities or what have you.
Yeah. I think if you hone in on what I'll call long volatility strategies, that would be an area I would start to give more weight to. And those strategies tend to be things that can produce what we'll call crisis alpha, or return when the markets abruptly shift. Those can be things like global macro managers. They can be, ironically, managed futures managers. They can also be long short. So that world we think is interesting. And doesn't mean that they'll be interesting for the next 10 years, but for this period of time, call it 2 to 5 years, we think that you should have a decent allocation to those strategies to help provide you some return should we have some abrupt movements in whether that's currencies or commodities or interest rates or equities. All those types of strategies can get you exposure to those asset classes.
Okay. So
Mhm.
are these things for the average retail investor, or are we looking at really institutional investors that really get access to this sort of stuff?
They're now accessible to the retail investor. That being said, I would say you should use a professional advisor to get you in them, because it's hard for an average individual to do the due diligence, the research, the appropriate weighting of these in a portfolio. You want to have an advisor kind of looking over your shoulder to say, this is how much you should have. This is what you should expect with regard to volatility and drawdowns and yield and returns. And so even though they might be available in mutual funds and ETFs today, or interval funds, I think you need to use a professional to help you do it.
Okay. Yeah, that makes a lot of sense.
Mhm.
Um, all right. Well, as we get close to wrapping it up here, final thoughts you can leave us with about the alt space.
Yeah, I'd say that, I mentioned it before. I would say that the next 10 years is not going to look like the past 10 years. I know we've all kind of lived in the last 15 to 20 years of a raging stock bull market. Things have, in my opinion, changed pretty dramatically over the last 24 months because of the interest rate environment and the inflation we've experienced. I would utilize alternatives in a more meaningful way than you would have historically. Diversifying a 60-40. Let's call it a third leg of the stool. You'll have your stocks, you'll have your bonds, but you'll have this third leg of the stool, which should hopefully give you some non-correlated returns as we look at the market moving forward.
Awesome. Well, Dick, I really appreciate you coming on. Where can people find more about you?
If you go to alphacorewealth.com, you can find out everything about our firm, what we do, and how we help our clients. And we look forward to anybody reaching out to us.
Great. Well, Dick, really appreciate you coming on the show, and we'll have you back on in the future.
Thanks a lot. Thanks for having me.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right. Well, that was a great interview with Dick. Really appreciate him coming to the show. And now we're into the panel portion of the show where you have our very own Barb Friedberg. Hey, Barb.
Happy to be here, ready to talk alts.
Awesome. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Thanks for having me today. Good to be here.
All right. Glad to have you both. Well, let's just dive right in. So, Barb, what were some of your takeaways from the interview?
Alts have become so popular. In researching for this episode, there were so many articles about how particularly those younger investors in their 20s and 30s and early 40s are diving into alts. They're more accessible than they've been in the past. You can get them in mutual funds. You can get them in specialty platforms, different crowdfunding platforms. You can buy real estate, non-listed real estate, commercial notes, prepackaged structured products, commodities. They're everywhere. So my question is, are they right for you? So I think that's what we need to delve into today.
Awesome. Well, we'll definitely do that. Phil, what about you? What are some of your takeaways?
So I agree with what Barb said about deciding if they're right for you. And there's some part of the reason I think they become so popular is all these stories out there. The 60-40 portfolio is dead. Is it? Do you need to do other things? And there are so many alternatives. I mean, it's good that he talked about a lot of different ones and diversification. I just wonder about, like, what does that do to your portfolio if you have that many different things in there? You want to make sure when you do this that you know who's involved.
Yeah, it's a great point, Phil. Yeah, I mean, my 2 cents to do a lot of alts. The alt space is like the shiny object syndrome, right? It's like this cool thing that everyone wants to be a part of, that they only want it in their portfolio because it's cool and it's different, and they want to be different. And investing is not that, not really the best way to show your individualism, your individuality. I don't know, individualism, it's not really a word. Individuality, and one of those days, I suppose. But realistically, like, alts are good for the right people, and although I do agree the 60-40 is dead, so we can take that in another direction. But so, Barb, we talked before the show. I mean, diversification is obviously very important. And one of the main reasons that alts are looked at is because they have the ability to have non-correlated assets or non-correlated returns, is probably a more accurate way to put it, within the alt space. So can you talk about that a little bit and how people can look at that?
That is the key point, because correlation means when one asset moves, price moves up, the other one will move up as well. Those are assets that are correlated together. So when stocks go up, if bond values go up too, well, then you're saying they're correlated together. Inverse correlation means when one asset price goes up, the other goes down. And in diversification, we strive to have assets that are not correlated, that are inversely correlated. And the reason for that is we all know what happens when assets are closely correlated. All we have to do is look at 2022, that unfortunate year when both stocks and bonds declined in value. There was no place to go. That was very unusual. That doesn't usually happen. So if you had had some assets in an alternative investment that was non-correlated with stocks and bonds and went up during 2022, your portfolio would have fared better. So that is one reason why you might want to consider investing in alternatives, is because they have been shown to be less correlated with stock and bond returns. This is not a guarantee, and it doesn't apply all the time, and it doesn't apply to every single type of alternative asset.
Yeah, that's really important. So Phil, what about you? I mean, we talk about diversification, non-correlated assets. What are some other reasons people should look at alts?
So they can give you exposure to different asset classes that you might than what you might already own, things that perform differently. It's like we talk about uncorrelated, negative correlation, whatever you want to talk about. But the key thing to me here too is let's think about sticking with our process, right? Like alts are hot right now. People want to talk about them, but don't go jumping from thing to thing, right? That's something that a lot of us do as investors that we have to be really careful about, is you want to have a process that you stick to it. If alts are part of it, that's fine, but don't just, if you're doing this yourself or if you're working with an advisor, call up your advisor and say, hey, do we have alts in the portfolio? What can we put in there? And then 6 months from now, they're not doing as well. And now you say, oh, let's get rid of those and move on to the next thing. You got to stick to a process. You got to find the ones that make the most sense for you. I mean, we can talk about all different kinds here. We have private equity, we have venture capital, we have long short, which is typically if you buy a stock, that means you went long. If you think it's going to go down, you go short, which is basically borrowing the shares and repaying in the future. You can use options, you can use futures. There's so many different things that you can use. So that's another reason too. There's even real estate is another one. It's another reason you want to make sure that if you're doing this, you understand who the manager is, what their strategy is, and what their track record is.
Yeah, I think that's really important. Let's talk about alpha here. Barb, you had brought this up for the show. What's the importance of alpha using alts?
Aside from being a Greek letter, alpha is a term used in investing to mean that you will get additional returns above the stock market. So frequently, alternatives are said to give you alpha. So if the stock market returns 10% 1 year and the alpha is 2% on an investment, that means you'll have gotten 12%. So that's another potential selling point for alternatives, that you can get higher returns. Wow, sounds great. Let's all pile into them. Well, not so fast, because we would all be remiss if we did not discuss what you might have to do to get more alpha. Because as we all know, there's no such thing as a free lunch. So if you're going to get an opportunity to have higher returns, then you're also going to have to take more risk. And the risk might come, for example, many alternatives require a lockup period. So a lot of managers, a lot of private equity, a lot even of the DIY alternative investment platforms that you can get into require that you keep your money tied up for 3, 5, 8 years. So yes, you might get alpha, but are you going to need that money before the investment is ready to be liquidated? Because if you are, you're going to be out of luck. So yes, possibility for alpha, there will be a trade-off and no guarantees.
So why would they lock up your money for such a period of time, Barb?
For example, let's take a private real estate alternative investment. These are springing up all over the place, and actually they are available for many everyday investors who don't need to meet a higher wealth requirement of being an accredited investor. So these private investors, they might lend money to a developer, or they might participate with an equity portion in a developer. And if any of you have invested in real estate, you know you don't just get your money out whenever you want. If you buy a building, you're not going to turn around and sell it tomorrow. Well, that's the same if you're investing in private equity. These are things that take a while to develop for the profits to emerge, and the money is tied up during that period. Maybe you invest in a commercial property where they're going to make improvements. They're going to drive up rents. They're going to make the building better. Well, you've got to wait the time for those activities to happen in the hopes and expectations that when they do, the value of the property will go up, rents will go up, and when they sell, you will get your return.
It's a great explanation. So Phil, what else should people be thinking about when it comes to alternatives?
First of all, be careful, right? And part of the reason your money gets tied up is, as Barb's saying with real estate, it's not just real estate. Like if you're doing private equity or venture capital, a lot of times it's not like when you buy stock in the stock market. Because when you buy stock in the stock market, unless it's an IPO, your money is going to another investor. They're selling shares, you're buying shares. But when you buy shares in private equity or venture capital investments, that money is also tied up. Why? Because they need it to run the business. So you're not going to have the same ability to pull the money out. So you want to think about, if you're making an allocation here, that you're comfortable that that amount of your portfolio is going to be locked up for a period of time, that you can't just get it out tomorrow. You also want to remember, as Barb talked about, there's risk. Like we talked about the idea of alpha, but there could be negative alpha, right? This investment could do worse in the market. You don't know that you're going to get that market beating return. You could have a market losing return. I mean, there's plenty of hedge funds out there. Some are really good and give good returns, but some of them don't at all. And you don't even know about them, because why? They get to a certain point, because how the payouts work, they shut down. They distribute whatever cash is left and they shut down, and then they might start up a new one, because they don't have to worry about and when you have a hedge fund, there's certain hurdle rates. Like if they don't, if they have losses, those have to be recovered before the fund managers can get paid. So they'll shut it down and restart. So there's lots of things like that that can happen too. You're not guaranteed to get a good return out of this. You can.
I also want to mention, we haven't even talked about fees. So when you're trading stocks, ETFs, you don't pay a commission. I mean, today you can invest anywhere, commission free. So there's very, very, very little cost to investing in the public markets. Now, if you buy an ETF, there will be an underlying expense ratio. Well, that ratio is a percentage of the value of your investment. For an index fund, you can pay as little as 0.03% or 3 basis points, which is like practically nothing. Let's say you're buying an actively managed fund. Well, you might pay 0.75%, which is higher, or even 1%. But with alternatives, the fees are likely to be higher. 1%, sometimes 2%, even more. And whenever you invest, any money that is going towards fees is not going into that investment. And so right out the gate, you are losing money.
That's a great point, Barb, and I'm going to bring up the other side of that, because I think that fees are obviously a very important part of any investing strategy. However, when you're looking at things like alternatives, and I use alternatives because they're all very different. Some people take the other side of that and they say, well, fees are the most important thing. And if I'm paying 25 basis points for a really cool thing versus paying 6 basis points, well, I want to pay 6. And they disregard everything else beyond the fact that they're paying 6 basis points. So I think what Barb's saying is really important, where the fees matter. But on the other side, I think fees aren't the only thing that matters. And if anything, it's the way I would look at it is fees, if all else is equal, you want the lower fee. But fees should not be the first thing you look at, right? So I use an example. If let's say alternatives, and this is maybe a bad example, but let's say the S&P 500 is earning 10% a year, just for this example, 10% a year, and this alternative is earning 50% a year. The S&P, let's say you're paying nothing, just to make the math simple, and the alternative, you're making 50% a year, but you got to pay 20% a year in fees. Well, you're still netting 30, right? So the math still lines up. It's better with the alternative because even though you're paying higher fees, because the net return after fees is higher. So you should always look at the net return, and I think that's a distinguishing factor. And and I'll use a more accurate example of I don't want to name it because I don't have to deal with the compliance, but there's a closed-end fund that owns only Bitcoin, and the fees I think are 2% a year. And people are like, I don't want to pay 2% a year. It's like, okay, so do you not want to invest in it? There's not a lot of other options out there. But if this thing is swinging 300, 400% upside, 70% downside, and you're paying 2% a year to get involved with that action, and that's what you want, well, you don't have another choice. If there was another choice, you pick the cheaper one. But if there's no other choice, you say, well, is it worth paying this 2% to access this asset that I really want to access? In my opinion, yes. If the investment's moving no more than 2% a year, right? If it's like really small change, no, you don't want that because it's so small. But if it's moving like, 3x, your multiples in one direction, is the 2% important? Not so much, like relatively. And so I think it's just important just to keep in mind, keep in context what you're investing in and what your purpose is. So fees are really important, as Barb says. Just it's not the tail wagging the dog here. So, but let's get into what you're invested in, right? So I think this is a big problem. How do you know what you're invested in? So Phil, what are your thoughts on this when it gets into what you're invested in? Like, how do you determine what you're in? Because I think with a lot of alternatives, they're not as I don't want to say they're not as transparent, but sometimes they're not as transparent. It's not like you can just look at a public filing of a mutual fund and say, oh, well, this is what we own. It's more it's less clear.
It's a lot less clear because the filing requirements are not the same. If you have a mutual fund, or if you own stock in a company, or you own an ETF, you're going to get a prospectus. You're going to get annual reports, quarterly reports that are going to tell you what they're doing, what's going on, what they hold. The mutual funds are going to give out reports every 6 months. So you get a 6-month report and an annual report. You're going to know what they hold. So you want to understand what the strategy is. I mean, there is a prospectus that comes with, like I looked at one not long ago for a private REIT. There was a prospectus. It talked about what the fees were. It talked about what kind of investments that they make. It talked a little bit about the background of the people running it. You want to make sure you understand all those things, because if you go in blindly, you have no idea. And it can change. You want to make sure that there's a demonstrated track record, that this person has experience, that they're qualified to be doing what they're doing. A lot of it, though, you're going to be on faith, because they're not going to disclose to you everything that they hold. Right? It's just not going to happen.
Yeah, so it definitely sounds like you're taking this a lot on faith. So what would be in your opinion, what would be the best way to go about that?
Like I said, you want to make sure that whatever documents that they have, you want to look through them, you want to understand them. If you have access to the people that are managing the fund, that you talk to them and make sure you understand their strategy, that they can clearly articulate it, that it's not like you look and there's one thing written down and you talk to them and they're doing something else. So you want to make sure that you get the best understanding that you can from the available materials. And you may have to do some other research that goes beyond that, so that you have a better understanding, because you may not get everything from the documents that they give you.
Yeah. Okay. Cool. So, so Barb, how can people go about finding alts for their portfolio? Like, what are some strategies people can use if they really want to go down this trail? Like, how can they find alternatives for their portfolio?
Let's divide it into two parts. One is you're a DIY investor and you want to add alts to your portfolio. And if you're the type of person, you manage your own portfolio, you can understand what you are invested in, and you know that you want a little bit of diversification beyond the stock and bond markets, then you're ready to delve in. And the places you can look for alternative investments fall into about 3 categories. One there are mutual funds, and less so exchange traded funds that will trade in a variety of different alts. So you can research these funds via Morningstar, via their websites, via online filings with the SEC, as mutual funds and ETFs are required to provide. Super easy. Then there are different platforms that these alts have set up. I have come across many real estate type investment platforms. Sometimes they're called crowdfunding. Some deal just in notes. We've talked about those before, different mortgage notes. Some deal in private credit. Some deal in startups. You can even invest on your own in a portfolio of startups. And you have to go to the websites, and I'm not giving any names, but what you'll do is you'll search the category and search alt, and trust me, they'll pop up. But then the key thing you have to do when you're researching these on your own, Phil gave great advice, but I want to reiterate, look at the manager, look at the manager, look at the manager. I see some guys with like, predominantly it's guys, but not always, that have like 5 years experience. Really? I wouldn't put my money with anyone with 5 years experience. Okay, so that's the DIY track. Then there's the advisor, and then you choose an advisor the way you would choose any advisor. Our guest is an advisor who deals in alts. He's one place to look. Again, the internet is a wonderful place to look for anything you want. If you want an advisor who deals in alts, then you just Google it and then you interview them yourselves. But be advised, like Phil said, even if you're using an advisor, first of all, you want to check any advisor you use on brokercheck.com, which tells you if they've gotten in any disciplinary action. Then you want to understand their fee structure so you know what you're paying and for what. And then when they do present alt investments to you, you still have to understand them, because I would not put my blanket trust in anyone.
Thanks, Barb. That's great. And so, all right. So one thing that was mentioned earlier in the panel was, which I thought was really interesting, and I know a lot of people are aware of it, but it doesn't get spoken about enough, which is a bad fund will shut down and restart under a new name because they want to hide their track record. And I've seen this a lot with mutual funds. They're getting started and they do a poor job, and then they just basically change the name and they can start fresh. What can investors do to limit the exposure to things like that? Or is there any? Maybe there's nothing. What are your thoughts, Phil?
I have not run into that specifically, but I would go back to what Barb just said about use the internet. You know who the manager is, look them up. You'll find their history. If they had another fund that they managed, I'm sure you'll find it there somewhere. Like, I know I've heard people interviewed and I don't know what fund they manage, and I look them up and I can find out what fund they manage and find out more about their history and their background and everything like that. So we have tools available to us. So I would do what I can to search and look them up. That's the only thing I can think of off the top of my head that we could do. It's just take advantage of the resources we have out there and do some research.
Okay, cool. Well, as we wrap it up here, Barb, final thoughts from you.
Yes. Any speculative type investment, which is a little more riskier than stocks and bonds, like alternatives, be prepared to lose 100% of your money. So in that case, determine how much of your total investment portfolio you would like to invest in that category. I recommend usually not more than 5%, but if you're a huge risk taker, maybe you want to go more. Just understand the risks. I am Barbara Friedberg. You can find me on YouTube and at Barbara Friedberg Personal Finance, where I have a couple of free ebooks that give you smart investing strategies.
Great. Thanks for coming on, Barb. And Phil, final thoughts from you.
I want to go back to one thing that we talked about before, which is fees. And only because you want to make sure that you understand fees. And we talked about ETFs and mutual funds, they have expense ratios. Even with that, make sure you understand what you're paying. Like, I did a workshop last week And I was looking at specifically S&P 500 ETFs. The lowest expense ratio I actually found had a 2 basis point expense ratio, but the highest was 1.61%. So you want to make sure that the same thing's going to apply to all. So you want to understand what you're paying. Look and compare one to the other. It's really important. And like Barb said with this, if you're going to do it, make sure that you figure out how much of your portfolio you're willing to put into it and how much you're willing to lose, because it could go to zero. So you want to make sure that you're comfortable with how much you invest and do your research. In my firm, I work with women experiencing big life transitions, which I know could be stressful. My job is to help those women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. You can download my free ebook at apprisewealth.com/ebook, and you can also go there and sign up for my blog. Thanks for having me today, Kirk.
Great. Thanks for coming on, Phil. And one final thought for me. We do a lot with alts. I love the idea of alts. I think, unfortunately, most people love the idea of alts as well, and they don't know enough about them. When we work with them, there are two different types. There are the strategies and there are the assets. The strategies are just basically a different way of managing money with the same assets you have. Alternative assets themselves can be interesting, but they can also lead you down a rabbit trail that you don't want. So you need to, if you're going to work with alternatives, you need to find somebody who is, let's just say, has a background and understanding of how to work with alts. Because it's something new. If you're in real estate and you know real estate, great. If you don't, don't just find an alt manager because they're an alt manager and figure you're going to be okay. There's a lot that goes into that. So just be careful. It's a great asset class or strategy, depending on what you're in, but just do your research. Don't go in blind.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.